Hello, my name is Jason Hulich, and as Head of Real Estate and Funds Management at Centuria, I'd like to welcome you to Centuria Metropolitan REIT's FY18 results presentation. As a specialist investment manager with $4.9 billion of assets under management, Centuria Capital Group continues to grow and expand a range of products across our platform. Real estate funds management remains integral to Centuria's operational activities. Along with inclusion on the S&P ASX 300 index, CMA represents Australia's largest ASX-listed metropolitan office REIT. CMA was listed in December 2014 and has proudly operated under the group structure since its inception. During that time, CMA has grown to $1 billion in assets under management and net tangible assets of $2.49 per unit, while providing investors with a total return of 58.8% since listing. CMA subsequently accounts for around 20% of Centuria's Capital Group's total assets under management. As the Trust's largest investor with a 19.9% holding, Centuria Capital Group's interests remain well aligned with CMA's existing investors. I'd like to thank you for your interest in Centuria Metropolitan REIT and now hand over to Doug Hoskins as Acting Fund Manager to present CMA's full year results for 2018.
Thanks, Jason. I'll now run through CMA's full year results with an update on our activities over the period, as well as our outlook and strategy for the year ahead. The Centuria Metropolitan REIT closed out the financial year well, growing to a portfolio value of $930.5 million, which consists of 19 investment-grade assets. The performance of the Trust over the period reflects a return on equity of 14.9%, which is an excellent result for unit holders. The REIT now has a market capitalisation of over $601 million and has delivered a 12-month total return of 7.2%. Since IPO in December 2014, CMA has shown a total return of 58.8% to unit holders, materially outperforming the S&P ASX 300 index return over the same period. In this time, CMA has also more than tripled assets under management and continues to enable investors to tap into the value on offer in metropolitan markets, an alternative investment to tightening yields of CBD office assets. CMA is well positioned with a strong occupancy of 98.9%, a 4-year WALE, and current gearing of 28.3%. CMA has continued its track record of delivering on earnings and distributions. This year's distributable earnings of 18.6 cents per unit and distributions of 18.1 cents per unit were in line with guidance. Our portfolio continued to improve this financial year with over $256 million in high-quality transactions. Valuation gains supported an NTA uplift of 7.3% to $2.49 per unit. The improvement in valuations were underpinned by key leasing transactions and continued investment appetite for quality metropolitan office assets. When including the upcoming settlement of 2 Kendall Street, Williams Landing, the portfolio has reached $1 billion in total assets for the first time. The REIT was also included in the S&P ASX 300 index, an important milestone which increases unit holders' access to liquidity. So on to the results. The REIT delivered on its FY18 guidance and saw a material revenue increase driven by acquisitions and leasing activity. The Trust focused on maximising its return on equity, driven by a strong focus on leasing and active asset management initiatives. Our in-house capabilities and strong tenant relationships help maintain a high occupancy rate that underpins income stability and drives positive revaluations. We are committed to our core strategy of active asset management and growing our portfolio through astute property acquisitions that complement our existing portfolio. We also continue in our focus to offer predictable and quality income streams to investors. CMA's debt book is structured across major domestic lenders with a staggered maturity profile which reduces refinancing risk going forward. The Trust has no debt maturities before December 2019. CMA has excellent access to both equity and debt markets, with gearing currently at 28.3%. CMA has debt facilities totaling $320 million and a low total cost of debt at 3.6% across the portfolio. The Trust continues to enjoy substantial covenant headroom in both its interest cover ratio and loan-to-value covenants. Our current LVR is 30.7%, showing $52 million headroom to the loan covenant of 50%. The flexibility offered by our balance sheet position and prudent capital management means we are well positioned to act when we identify value opportunities in the market. Throughout the year, CMA's portfolio increased to 19 high-quality, institutional-grade metropolitan assets, up from 15 at the beginning of the year. Upon the completion of the purchase of 2 Kendall Street, Williams Landing, the REIT's income stream will be spread across approximately 185,000 square metres of lettable area. Our portfolio is geographically diverse, with significant weighting to the eastern seaboard. 13 properties, making up 43% of the portfolio, are located in the high-performing states of New South Wales and Victoria. The portfolio also has strong green credentials, with an average NABERS energy rating of 4 stars. This achievement has been driven by management initiatives throughout the year. FY18 was a year of strong leasing activity that has seen the Trust hit 100% occupancy in 4 of its 6 investment markets. Our Canberra, Southern Australian, Western Australian and Victoria assets are all 100% occupied, with New South Wales and Queensland at almost maximum occupancy. We continue to proactively manage our property portfolio and have leased approximately 18,000 square metres this year, representing 9.75% of the portfolio's net lettable area. CMA unit holders benefit from a robust tenancy profile underpinned by high-quality corporate and government tenants. The quality income streams are also well diversified, further de-risking income continuity. 47% of the portfolio's expiry profile is out to FY23 or beyond, with a WALE well placed at 4 years. The portfolio occupancy is currently at its highest since inception at 98.9%, an excellent result that demonstrates the strong capabilities of our in-house asset management team. Our direct tenant relationships mean we often have additional visibility of upcoming vacancies, which enables us to minimise downtime, further protecting revenue streams. CMA continues to maintain leasing momentum and is focused on addressing FY19 expiries. CMA's portfolio value increased year on year by 52.6% to $930.5 million as a result of quality acquisitions and valuation increases in the portfolio. The weighted average capitalisation rate of the assets firmed 51 basis points to 6.68%. We are pleased to report that the transactional activity throughout the period was accretive in comparison to the portfolio's like-for-like average capitalisation rate. Acquisitions occurred at a comparatively higher average cap rate of 7.1%, and Carlingford Road sold at a comparatively tighter cap rate of 5.25%. CMA's agreement to acquire Target's headquarters at 2 Kendall Street, Williams Landing, Victoria, remains on track, with recent transactional activity in the area suggesting the potential for further rental and capital value uplift. Diving into further detail on our FY18 transactions, we divested 2 assets, both in New South Wales, 3 Carlingford Road for $36 million, showing a 27.2% premium to book value, and 44 Hampton Road for $10.3 million, which reflected an IRR to unit holders of 18% over the period of CMA's ownership. The sale of 3 Carlingford Road represents the fulfilment of a strategy to deliver and unlock capital to CMA unit holders. The REIT also made 4 high-quality acquisitions totaling $256 million. Of particular note is our 50% stake in 201 Pacific Highway St Leonards, which consolidated our position in the market alongside the Trust's sister asset at 203 Pacific Highway above the train station. Recent market evidence shows that CMA has successfully positioned itself to benefit significantly from spillover tenancy demand from the CBD and other lower North Shore markets. CMA also acquired 77 Market Street, Wollongong, one of the preeminent office buildings for corporate occupiers in Wollongong. It has a strong tenancy profile including Medibank Private, Illawarra Retirement Trust, Fairfax Media and KPMG. Our acquisition of 77 Market Street is evidence of our ability to uncover value. This asset was acquired wholly off-market from Medibank Private as part of a 7-year sale and leaseback. We also acquired 144 Stirling Street in Perth, which is predominantly leased to the Western Australian Government, and 42 to 46 Collins Street in West Perth with its major tenant of IAG Australia. These transactions were well supported by CMA's investors and lenders, which we believe firmly has cemented CMA's position as a leading metropolitan office REIT. On to our strategy for the coming year and guidance on earnings and distributions. Our focus throughout FY19 and beyond will be continuing to build Australia's preeminent metro office REIT. The coming year will see us complete the acquisition of 2 Kendall Street and the settlement of 3 Carlingford Road. The Trust also anticipates the divestment of the portfolio's industrial assets if market conditions are favourable. Should the sale of the industrial assets occur, CMA will provide investors with a pure-play metropolitan office portfolio. The industrial properties are quality, well-located assets with excellent tenant covenants, and we anticipate keen interest from the market. The REIT will continue its strong leasing momentum with a particular focus on addressing our expiry profile. CMA's bottom-up market research, which enables quality asset selection, our active asset management and close relationship with tenants are the foundation of our success. CMA remains focused on generating a predictable, quality income stream and executing initiatives to increase value. Our diversified, high creditworthy tenant base will underpin this income stream during the 2019 financial year. We will continue to leverage our strong tenant relationships to benefit the occupancy and WALE of the portfolio. Subject to favourable market conditions and the potential sale of the industrial assets, CMA will offer investors exposure to a pure-play quality office portfolio managed by a team with a track record of generating value. CMA forecasts FY19 distributable earnings of 18.3 to 18.5 cents per unit and distributions of 18.1 cents per unit. The FY19 distribution forecast reflects a distribution yield of 7.3%. I'd like to thank our unit holders for their support over a rewarding 2018, and we look forward to continuing to deliver value over the coming year. On behalf of the management team, we thank you for taking the time to listen to the results presentation.